are worth mentioning. The largest silver refinery in India evidently has run out of stock for the first time in history. India being one of the largest buyers of physical silver. That's a big deal. I think worth certainly mentioning. The managed money is short by over $1 billion on silver, meaning the commercial banks took the other side. I wonder how that's going to play out. I would suspect you'll see silver really start to move this week when the managed money, the dumb money in relation to the commercial banks, the ones that seem to always be on the right side of the trade until one day they're not. And maybe this is the one day one would expect silver to really start to move higher here right now. I don't like to make those kind of predictions, but I will tell you that this is very unusual to see how short the managed money.
For the first time in years, the silver market is flashing signs of real stress. Andy Schectman, CEO of Miles Franklin, points out that the LBMA has been in backwardation for 18 straight days, meaning the spot price of silver is higher than the futures price by about $1.24. In normal markets, futures trade higher because of storage and financing costs. When that flips, it signals desperation for immediate physical delivery. People aren't waiting for paper promises anymore, they want the metal now. Schectman says the pressure is also visible in short-selling costs. Traders trying to short SLV, the main silver ETF, are paying an annualized rate near 19%, while lease rates in London have spiked to 39%. Those are levels you see when supply is tight and trust is fading. Even big institutions are taking notice. Bank of America just raised its silver forecast to $65 per ounce for next year, with an average of $56.25, and lifted its gold target to $5,000. At the same time, Morgan Stanley's chief investment officer is advising clients to ditch the old 60-40 portfolio and shift to 60% stocks, 20% bonds, and 20% gold. Bank of America strategist Michael Hartnett is pushing an even more balanced model, 25% each in stocks, bonds, short-term treasuries, and gold. And Jeffrey Gundlach, long known as the Bond King now, says a 25% gold allocation isn't extreme anymore. When the bond market's biggest names start endorsing gold, Schectman says, it's not a fad, it's the sound of the financial establishment quietly preparing for a monetary reset. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Are worth mentioning. The largest silver refinery in India evidently has run out of stock for the first time in history. India being one of the largest buyers of physical silver. That's a big deal. I think worth certainly mentioning. The managed money is short by over $1 billion on silver, meaning the commercial banks took the other side. I wonder how that's going to play out. I would suspect you'll see silver really start to move this week when the managed money, the dumb money in relation to the commercial banks, the ones that seem to always be on the right side of the trade until one day they're not. And maybe this is the one day one would expect silver to really start to move higher here right now. I don't like to make those kind of predictions, but I will tell you that this is very unusual to see how short the managed money is. You know, right now that the LBMA is blowing up in terms of running out of stock, you have, for the 18th day in a row, backwardation between spot and futures. Right now it's about $1.24. This tells you that the people are paying extra to get real silver now, not in the future. This is not bearish. This is a panic for the real metal. At the same time, short sellers are now paying a 19% annualized rate just to borrow SLV shares, where we see a lot of shorting, and a 39% lease rate on the LBMA. This is not indicative of a well-functioning market. Bank of America on Monday raised its forecast of silver to 65 per ounce by next year, with an average of 56.25. Until then, they also lifted their outlook to gold for 5,000. And the last thing that I will say is, and I may have repeated this last week, but for people who haven't heard this, you got 4 or 5 things that are incredibly bullish. You got, as we mentioned before, Morgan Stanley saying no more 60-40, 60-20-20. Get rid of half your bonds, buy gold with the other half. 60% stock, 20 bond, 20 gold. When have you ever heard a financial advisor say 20% in gold? This is from their chief investment officer, their CIO. This guy and the people that I'm about to mention speak to not the plebes, but to the institutional level traders. not to the rest of us. They're saying put 20% of your money in gold and pare down your bond holdings by 20%. Michael Hartnett for Bank of America, this is the one that just said, 60, whatever, $65 on silver. Michael Hartnett's newsletter, I don't know how much it is, but I bet it's 10 grand a year. He just came out and said, no, it's 25, 25, 25, 25. 25% stock, 25% bond, 25% short-term treasury, and 25% gold. Whoa. Then you get Jefferies. Now, as you mentioned at the onset of this meeting, we were blessed by Prudential Beige about 20 years ago, and they nominated us. The authorized resellers, the 6 or 7 of them, can nominate one primary reseller, the primary distributors can authorize one authorized reseller. And they did. Prudential Beige authorized us or nominated us to be an authorized reseller, one of 27, about 2 decades ago. God bless them for that. Walter Pahowicz. If he's still out there, Walter, I love you. He used to run their desk. They got bought by Jefferies. And Jefferies Beige was the name. Jefferies Beige was a primary distributor for all the major mints. They understand gold. They subsequently got out of the market, sold off the Beige name, and it's just Jefferies. Their head trader is saying $6,600 gold is their next stop. They understand gold. But maybe the biggest of them all is Jeffrey Gundlach, the bond king, the man who's made his mark, his fortune, and his moniker of being the bond king by selling bonds, who just came out and said a 25% portfolio allocation to gold is not overweight. Really? So when you see these people at these levels, and then put into it all the stuff coming into COMEX and the draining on the LBMA and the high lease rates and all of this stuff, the Judy Sheltons of the world, and the Trump saying he who has the gold makes the rules, and Besant saying, I want to remonetize, be part of a new monetary. Keep going. I'll keep going. And I'm telling you, and I hate to say it, I cringe saying it, but this time it's different. And look at gold. Got the snot kicked out of it by over $100 last week on Friday. And what are we at today? We're up $108 right now as we speak. The physical demand is different than I have ever seen, as are all of these things. People at that level, speaking to institutional traders at that level, saying 25% allocation is good. Never seen that before, man. Not even close.
Andy Schectman says the banking crisis didn't disappear, it just fell out of the news cycle. Behind the scenes pressure is building again. Commercial real estate loans are going bad as office buildings sit half empty and tenants stop paying. The same pattern is now spreading to residential real estate and auto loans. Banks that counted on steady payments are instead watching their cash flow dry up. To keep operating, many banks are turning to the repo market, a short-term funding system where they swap assets for overnight cash. Schectman says that in normal times, they'd use safe collateral like U.S. Treasuries. But today they're increasingly pledging riskier mortgage-backed securities just to stay liquid. That's a major red flag, he warns, because it mirrors what happened before the 2008 crisis. In response, the Federal Reserve has quietly stepped in. Schectman notes that the Fed recently injected nearly $9 billion into the system and opened a $490 billion emergency lending facility for banks. Those aren't precautionary moves, they're defensive measures. A $500 billion backstop suggests policymakers know something is breaking beneath the surface. He believes this stress will eventually spill over into the broader economy, forcing the Fed to choose between saving the banks or saving the dollar. Let's get back to the interview.
Because there was more fanfare of the stupid anti-King rally or whatever it was, and CNBC came out and they were showing videos from 2017. I digress. We don't need to talk about that. But what I will say is that we've settled for a long time, Dunnigan, that the banking issue is not over. And it's been muted, yes, for sure. But what this is, in essence, is a bunch of commercial real estate and residential real estate loans are going bad. Auto loans, they're all going bad. People aren't paying. They're running late. They're delinquent. No one's in office buildings. I was at my attorney's office in Minneapolis last week. They have 3 floors of an office building. Felt like I was in a morgue, literally. And they re-upped it like right at the beginning, right before the pandemic hit. They re-upped a 10-year lease. In downtown Minneapolis, you could have 10,000 people on these 3 floors, literally, and there's no one there. It's crazy. But this is the kind of problem, not my attorney's office, but many like it, where they're delinquent. They're not paying. They're going into forfeiture. And so you have a bunch of these loans that are going bad, which makes the banks run low on cash. They're not getting their payments. So to stay afloat, they go and they hit the repo market, where this is where banks trade assets, typically U.S. Treasuries, for quick overnight loans from the Fed. I'll give you my treasuries. You give me some money, and then I'll buy back the treasury the next day or next week or whatever. It's overnight. It's next day. Some are longer than overnight, but that's why it's called repo. It means repurchase. Here's my treasury. Give me some money so I can pay my debt. I'll give you back the treasury, or I'll buy back the treasury the next day. Great. The scary part about all of this is that now these banks are pawning off their risky mortgage-backed securities instead of the safe treasuries. That is the sign of stress. That is what should be disconcerting. This is why the Fed injected almost $9 billion and opened up a $490+ billion emergency facility. Shh, don't tell anyone. No one knows about it. It's $500 billion. And you don't do that unless something is beginning to fracture underneath the seams. And this is what we said would happen. And that's the part, that's why I'm so fond of the little by little, the logarithmic decay, because the little by little, these things that have been breaking little by little under the seams, instant gratification, even in information and in thought process, isn't quick enough for most people in this country. They aren't able to understand that these things take time. At this level, it is an ocean liner trying to turn. These are very big deals, and they're not getting fixed organically. And the problems with commercial real estate are only going to get worse, as are the problems with residential real estate. The only way the residential real estate problem gets better is for prices to go down and or for interest rates to go higher, not lower. That's what got us in this problem to begin with. Well, the commercial real estate is a whole nother animal altogether. You got all of these companies that realize, well, we're just as productive working away from the office as we are in the office. So why spend all the money? And it's creating a real problem. The banks are not out of the weeds yet. And when you see the Fed coming in and quietly doing this without, again, our media just is pathetic. Our media, guys like John Rubino, God bless them, guys like you, all the people who are telling the truth and getting the real information out. These are the ones that were shadow banned during the previous administration for misinformation that turned out to be true. But here again, where is the journalistic integrity? Where are the news media outlets talking about what is exactly happening? And what it means is the banks are in trouble. And not only that, no one wants to leave their money in the bank. They'd rather move it to treasuries, which short-term treasuries with disintermediating the bank, or even into money markets away from the regional banks and into the bigger banks. The problems are not done yet. And this is a good sign of it. When they are trading their mortgage-backed securities instead of their treasuries, they're in need for cash, and cash quick, and they're in trouble. It's kind of like, you're pawning off your wedding ring at this point, and hopefully you'll lend it to the pawn shop. Hopefully you'll buy it back, because your other assets are already gone. And it's a very scary sign, to be honest with you.
What's happening in the precious metals market isn't just another trading anomaly, it's a signal that the system itself is starting to crack. Silver's backwardation, surging lease rates, and rising short costs all point to the same truth. Trust in paper promises is evaporating. When futures prices fall below spot, it means people no longer believe the metal will be there later, they want it in their hands now. That shift from confidence to urgency is spreading beyond metals. Banks are quietly leaning on emergency facilities, the Fed is backstopping liquidity again, and major financial houses are openly recommending gold as a core asset rather than a hedge. These aren't normal times, they're the opening chapters of a financial reset playing out in real time. As credit tightens and real assets reclaim their place at the center of wealth preservation, the traditional playbook, stocks, bonds, and blind faith in the system may no longer apply. If the smart money is already preparing for a new monetary order, how long will it take for the rest of the world to realize the rules of finance have changed? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.